Alright children, welcome back to AP Macroeconomics with your favorite teacher, me, Mr. Fritz. Today we're going to talk about bank balance sheets and how banks create money. To start off the video, first thing I'm going to do is go through the parts of the bank balance sheet. It's essentially just a T-chart. There's two sides to this. On one side we have liabilities, and for liabilities you can kind of just think of that as being things that the bank has that they owe back to other people. It's money that is not the bank's, and that's why demand deposits is on that side. For a bank, demand deposits is other people's checking accounts. This bank has $100,000 in its demand deposits, and that means at any point when people come in to try to get their money out of the bank, this bank has to give it back, and that's why it's a liability. On the other side of the bank balance sheet, we have assets. Assets you can think of as being things that you own that are worth money. You could sell them to settle debts if you have to. For a bank, loans are an asset because that's the money that's been lent out that the bank is going to get paid back plus interest. Reserves is the money that's actually sitting in the bank still, and for a bank, reserves are also an asset because those are potential loans. Farther down, we have required reserves. That's the percentage of money that is in banks' checking accounts that the bank has to hold on to no matter what. The required reserve ratio is set by the Federal Reserve. For this problem, I made up a number, it's 10% on my problem. The Fed sets the required reserve ratio, and that's the percentage of money that's sitting in banks' demand deposit accounts that they must hold on to no matter what. Those are the parts of the bank balance sheet. Now I'm going to show you how to read one. Alright, the most important part of the bank balance sheet. Every time you get to one of these problems, the first thing you need to do is circle the demand deposits. That's how much money is actually sitting in the checking accounts at that time. The demand deposits are the most important account because everything else is dependent on it. The demand deposits is the money that has been lent out and is the money that's actually sitting in reserves. This bank has $100,000 sitting in its demand deposit accounts, $60,000 of which has already been lent out. There is still $40,000 sitting in the bank. And the bank is going to do what banks do. They want to loan it out. When banks make loans, they're creating money out of thin air. Think about it. If I went to my bank and put $100 in my demand deposit account or my checking account, and the reserve requirement ratio is 10%, that means that my bank has to hold on to 10% of my $100 no matter what. That's 10 bucks. With the other $90, they can lend it out. Once the money's been lent out to someone else, if I come back and want my money out of my checking account, they have to give me it. And they don't just have to give me the 10 bucks, they have to give me all 100. So if I pull my $100 out after that loan has been made, that $90 still exists and my $100 still exists. So when banks make loans, they're creating new money. Like we said before, this bank is holding $100,000. There is a reserve requirement ratio of 10%. So 10% of that $100,000 must be held onto at all times no matter what. 10% of $100,000 is $10,000. That is the required reserves amount. This bank is still holding on to $40,000. That means that they have excess reserves of $30,000. And if they have excess reserves, they're allowed to lend that out. So let's say that this bank makes a $30,000 loan to someone. I don't know, maybe they're buying a new fancy car, something like that. They have just created $30,000 new dollars. $30,000 that did not exist until that loan was made. Because again, if the people who have their money in this bank want to come take that $40,000 out, they can. So this $30,000 exists now. This isn't where the money creation stops either. The person who took out this $30,000 loan is not going to walk around with money in their pocket, or whoever they paid $30,000 to is not going to walk around with 30 grand in their pockets. That money is going to end up back in a checking account. And if it does, their bank can lend out 90% of it as well if they still have a 10% reserve requirement ratio. And that money can be lent out over and over and over again until all of it has either been sitting in required reserves or is lent out and outside of the bank. Instead of walking through all these steps where like, well, one person comes in and gets a $30,000 loan, puts the money away, their bank lends out 90%. That person that took out that loan puts it back in a bank and their bank lends out 90%. Instead of doing all that, we are going to have a nice little money multiplier formula. And the money multiplier is going to be equal to 1 over the required reserve ratio. Or 1 over RRR maybe. Or 1 over a little flock of birds. My R's look like little flocks of birds. They're flying away. Alright. so 1 divided by the required reserve ratio right now would be 1 over 0.1, and 10 cents goes in a dollar 10 times. If you have struggles with math like I do, I just pretend like it's change because we've all dealt with change before. 10 cents going in a dollar 10 times is pretty easy. Alright, so we're going to do 30,000 times 10. And that initial loan of $30,000 could create up to $300,000 in the total money supply in the banking system. That's if every single person that takes out these loans puts the money back in the bank and their bank lends out every last cent that they can. If someone goes home and puts the money under the mattress, it can't be lent out again. Or if a bank doesn't want to lend out every dollar it's allowed to, then this number will not be hit. But at most, because of the 10% reserve requirement ratio, lending out $30,000 can increase the money supply by up to $300,000 if every bank's lending out everything it can. So that's been a really quick overview of bank balance sheets. Next time we'll talk about how the Fed increases the money supply by buying government bonds. I'll see you next time. Goodbye.